Uber. I mean, it's a verb, right? It's a company that has completely changed how we get around our cities. But what does its future actually look like? Today, we're going to dig into a really fascinating analyst report to understand the one massive tech shift that could either supercharge Uber's growth or, honestly, threaten its very existence. Okay, let's get into it.
For a company this big, so integrated into our daily lives, it's really easy to just assume its dominance is a done deal. But the analysis we're breaking down today asks a pretty critical question. Is it really? And as we'll see, the answer is, well, it's far from a sure thing. And make no mistake, the stakes here are just enormous. That number? That's Uber's market capitalization, according to the report we're looking at. Over $150 billion are riding on whether this company can successfully navigate the road ahead. So, first things first, let's understand where all that incredible value comes from. Uber's real core strength, what analysts like to call its economic moat, isn't just its brand or its app. It's something much, much more powerful than that. It's called a network effect. Let's break down exactly how this works. It's this beautiful, virtuous cycle. So more riders in one area means less downtime for drivers, which of course attracts more drivers to the platform. And more drivers means shorter wait times and better reliability for riders, which, you guessed it, attracts even more riders. It's this brilliant feedback loop that makes Uber service so incredibly sticky. And this isn't just some abstract business school theory either. Analysts are tracking the health of this network with very specific metrics. They're asking, are new users joining? How often are people actually taking trips? And is Uber getting better at making money from each one of those rides? And wow, this slide really just lays it all out there. The report shows that an average Uber user takes about 17 trips. Now compare that to their main competitor, Lyft, where a user takes only about half that. This isn't just a small gap, folks. It is a massive difference that really shows you just how powerful and embedded Uber's network has become.
So Uber has this incredibly powerful, self-reinforcing network. It seems almost untouchable, right? So what could possibly disrupt it? Well, the answer is a technology that strikes right at the very heart of that network: Robotaxis.
Just think about it for a second. The entire supply side of Uber's business, the millions of human drivers, could potentially be replaced by fleets of autonomous vehicles. This one single change presents both the biggest opportunity and, frankly, the gravest threat in the company's entire history.
The critical thing to understand is that this can go one of two ways. The absolute dream scenario for Uber? Partnership. AV companies plug their self-driving cars into Uber's network. The company's biggest cost, paying drivers, plummets, and profits just soar. But then there's the nightmare scenario: competition. Companies like Waymo and Tesla build their own apps, connect directly with riders, and cut Uber out of the picture entirely. And this fork in the road is really the source of a huge debate among investors and analysts. So let's look at the core arguments from the bulls, the people who are optimistic about Uber, and the bears, who are not. All right, the bull case is pretty simple. Uber's network of riders is just too big to ignore. If you're an AV company that spent billions on robotaxis, you need to get them filled with paying customers, and fast. Plugging into Uber's massive, existing demand is the quickest path to do that. They see Uber as the ultimate matchmaker. The bears, on the other hand, look at it completely differently. They argue that these AV companies have a way better cost structure since they don't have to pay drivers. So why would they give a cut of their profits to Uber when they can just develop their own app, control the whole experience, and keep all the money for themselves? So you've got two very compelling but completely opposite visions of the future. Let's get to the analysts' verdict and see how they weigh these really powerful forces against each other.
And this really illustrates the complexity of the whole situation. The analyst concludes that the future isn't a simple win or lose. The most likely outcome is actually a messy, complicated middle ground, where Uber has to navigate a hybrid world of both human drivers and autonomous fleets, probably with lower profits than the bulls are hoping for.
This conclusion is reflected right in the report's formal rating. Uber gets a very high uncertainty rating. And that's not just a casual phrase, it's a specific label that tells investors that the range of possible outcomes here, from wild success to total disruption, is exceptionally wide. All of that uncertainty is baked directly into the analyst's price target. Their fair value estimate of $85 a share is really trying to balance the immense power of Uber's current network against the profound long-term risks that the whole autonomous vehicle revolution brings to the table. Which leaves us with the ultimate question. Uber has built one of the most powerful network effects in the modern economy, no doubt. But it's now facing a technological shift that could rewrite every single rule. The answer to whether Uber will own the future of transportation or just become a relic of its past, well, that story is still very much being written.